Hey guys, we've got Blake Pitts on this week on the podcast, and we're going to be talking about stock market and trading and futures. And if you want to know why risk management is more important than wealth management, then you're going to stay tuned for this next episode.
Hey, this is Liz, and you're listening to the SouthCack Syndicate Podcast.
Episode 28. Jared Cutterman here with my cohort partner in crime,
Kyle Voss.
Special guest today, Blake Pitts.
This is going to be a good one. We're talking money.
Yeah. All of them are good one, man. What are you talking about?
Well, that's true.
Dude, but I went and binged like 3 or 4 of our last ones with Brad and these guys. And it was just good content.
Yeah. Well, you know what I like about it too is when we bring in guests, it forces us to kind of get outside of our box. Mm-hmm. So we're not talking about the same thing all the time, right? Mm-hmm. We get in somebody else's world and then we can kind of throw ideas around or whatever.
Yeah, no doubt. Okay, so
investing.
Stock market.
Yeah, well, I think we should talk about
wealth management.
You go.
Risk management.
Yeah, risk management, wealth management.
Day trading.
We're going to talk hard assets. We're going to talk paper assets.
Yeah.
Digital assets, maybe.
I hope not. Welcome to the podcast, Blake Pitts. Welcome to SouthCack Syndicate.
Yeah, it's good to be here. It's good to be here.
So Blake was supposed to be on with us last week. Yeah. I think we kind of mentioned that. Mm-hmm. And we're kind of talked about it before the podcast. We think it was allergies, but the voice went.
It's back. Yeah, well, yeah, it's gone. But it was gone for a couple of weeks, and I do a little speaking on Sundays, and by the time I get to the end of preaching, it's usually pretty rough. So It was a rough couple of weeks, but I think I'm going to make it. I've got some strength in it.
Speaking of that, go ahead and give yourself an introduction. Give us like the ground level of Blake Pitts.
Yeah. I guess my main gig is I'm the lead pastor at Life Point Church. Okay. So I do that. Life Point Church has been in existence for about 10 years now. Brad was here last week.
Yeah.
Last week. And so he probably told you a little bit about that. My other gig is that I'm an investment advisor at IQ Capital Strategy here in Seneca.
Which fits you because you're a math teacher, right?
I was a math teacher. I taught math for 3 years. Before I went to ministry, and so I like numbers. I like the market. I like
geeking out on that kind of stuff.
Things geeky, charty.
Yeah. Which is probably why you're so deep into athletics too. I guess. Yeah. Partly. Yeah. Because it's like I don't know, not the same thing, but
have you not seen Moneyball?
Well,
Moneyball.
Yeah, that's a great show. Great show.
True. It's a true story. I think Jonah Hill and Brad Pitt did a great job with that one.
Yeah.
And it's all about analytics, and they changed the entire way the game of baseball was played from the desk, not from the field.
Right. They were going based on averages.
Exactly. They could care less what you look like, how old you are, what are your numbers on the Excel sheet.
Yeah, how great people thought you were.
Awesome. If you look at Major League now, I mean, everything's wrong on analytics. And
that's right.
I mean, baseball, football, they're doing all kinds of crazy stuff now. The whole shifts in baseball that they do, they've outlawed this year.
Oh, really?
They've outlawed it. You can't do it anymore. I think that starting this year, you can't do the shift anymore.
And so that was probably based on what that batter, they probably had some kind of...
Yeah, they have a chart on where they hit the ball.
Most of the time.
It would literally move the players.
Right, exactly.
To where they hit them all. Every single player, they'd move. Everybody would move. It's insane.
So they'd be calling plays. They'd be a guy on the sidelines looking at the batter going, okay,
everybody move left.
This is play T6.
He's going to go between second and third every single time.
Mm-hmm. Yeah, that's interesting.
It's crazy.
I mean, honestly, that's the way to play it. I mean, it is kind of the exact same way the market works. Yep. Like you're basically playing the emotions of people. Mm-hmm. It has, in the long term, it has a lot to do with the underlying fundamentals of the company. But in the short term, it's all about the mindset of the people who are buying and selling those stocks. Yeah. So am I wrong?
So Blake, would you say you're into wealth management or risk management?
Mainly risk management. Mm-hmm. Everything is a management of risk.
Explain that a little bit.
Okay, so if you're ever going to do anything beneficial at all, you're going to take some type of risk, right? You're going to take whether it be financial risk, whether it be health risk, whether it be whatever. I can't learn to ride a bike without taking the risk of maybe falling down and getting hurt. So if I'm going to do anything that's worth anything, I'm going to have to take some type of risk. And so the idea is I'm going to have to manage that risk to where the first time, like the maiden voyage, I do something, I don't, in the investment world, lose all my money, right? So I'm going to cut that. I'm going to make sure that I manage the risk that I have in order to keep me in the game long enough
Right.
to figure out an edge in whether it's in trading or whatever it might be. So I can figure out an edge to where, okay, I think I can make money doing this. I'm looking at this chart, I'm seeing this pattern, I see this stock, I see whatever. And if I can manage my risk enough to keep me in the game long enough to figure out when I win and when I'm going to lose, then I'm doing things the right way.
Right. Now, would you call that like you look for asymmetric upside, like little risk with a greater return? You know, I guess the worst trade is the 50-50 trade.
Yeah.
Because let's not shoot that far up yet. Give us an example. Like, okay, you grab Kyle's portfolio. Now put risk management into that conversation.
Yeah.
So not everybody, if you're driving down the road, not everybody knows how the stock market works or what risk management is or anything like that.
That's true.
What
That's
50-50 A list B, I don't know what the heck
Okay,
you're talking about.
so here's what happens. If you go into 90% of the wealth management places, you know, anywhere, what you're going to do is you're going to go in there. They're going to say, how old are you? You know, if you're young, they're going to, all right,
High risk?
Yeah, you can be high risk. You know, you got a long time to be in the market, whatever. You can do it, you know. They're going to ask you what your risk tolerance is, you know, and if you're young, you say, well, you know, I want to make money and I want to lose. Nobody ever wants to lose money, right? I mean, nobody wants to lose money. But they're going to ask you those questions. And so what they're going to do is they're going to put you in a portfolio where, you know, 80% of your money's in stocks and 20% of it's in bonds, or you have a growth mutual fund or a balanced mutual fund or a bond weighted mutual fund,
right.
Whatever, you know, there's going to be all these kind of things. And they're using what they think is risk management tools when they're really not.
Yeah.
You know? I mean, because if they put you in 70% bond or 70% stocks and 30% bonds, if the market tanks like it did at COVID, everything's going down.
Yeah.
Like it's not like bonds is going to protect you,
right,
know, and
from the downside.
So putting a certain amount in bonds is not risk management.
It's just preserving it as long as it's not like a black swan event, I guess.
Yeah. Well, and not even that. I mean, black swan events are even worse. You look at COVID, the 70-30 split portfolio went down anywhere from 25 to 30%.
Yeah.
During COVID. The same as
everything else.
The regular market.
Yeah.
You know, so that's not risk management. Risk management is so, for instance, you want to, when you trade, you want to be able to cut your losses, even though it may be super emotional. You want to be able to cut your losses at a fraction of what you take your gains at.
Right. So you put in stop losses or something.
Yeah. So you put in stop losses, you go to cash. All right. So a stop loss, if you don't know what stop loss is, stop losses, I can put in a stop loss that says, hey, if it hits this price, I'm getting out. I'm selling.
Yeah.
All right. So if I put on a trade and let's just say, for instance, I have a 2-to-1 risk reward ratio. What that means is I'm going to take my profit at twice what my risk is. All right.
Right.
At twice what my risk is. If you do that, then you only have to be right 35% of the time. Like you don't have to be right 50% of the time.
Yeah.
Right? Because a 1-to-1 risk reward, like if I said, all right, I'm going to take my profit. Let's say you have a stock that's $10, right? So
Okay.
I'm going to take my profit at $15. I'm going to cut my losses at $5. All right.
Yeah.
That's a 1-to-1, right? I'm going to take it at 5 or I'm going to lose.
You're going to make 5 or lose 5.
Make 5 or lose 5. Then you have to win what? You have to win 50% of the time.
Yeah. And it's not a good bet.
And that's
it depends on the dealer that's spinning that roulette wheel.
well, that's where I was getting to.
We manage risk at the casino a little bit. It's the exact same conversation.
It is. But here's the thing. It's a math problem.
It is a math problem.
Right? It's a math problem. Because
so,
I can blindly take a trade and set it at 2-to-1. 2-to-1 risk.
And it automatically.
And if I take 10 of them, all I got to do is win 4 of them.
Yeah.
Make money.
Yeah. So what you're saying is, you say you buy a $10 stock, you put in your stop loss at $5. So you're the most you can lose is $5.
Yep.
And I'm trying to keep this in simple terms.
Yep.
But you have your sell price at say 20.
Yep.
That's your 2-to-1, right?
Yep.
That's how that works. So you could make 10 or you could lose 5.
Yep.
That's a good bet. Versus you make 5, lose 5.
Yep.
That's the 50-50 side that we were talking about earlier. And that's what I consider asymmetric risk. It's like risk. It's like how much you're betting for how much you could potentially make.
Yep. That's right.
Right? You want the biggest potential upside for the least amount of risk.
Yep.
And if you can find those, it's tough. Obviously, if it was easy, everybody would do it. But
So here's what's cool. Our company, we basically run an algorithm. So we buy and sell out of the top 20 stocks in the S&P. So these are your Amazon. It's in your latest marijuana.
Yeah, you
stock.
can get out easy. Yeah.
So we can, because we have this computer system that can back test everything, right?
Right.
So we can back test. So we can put in, these are our rules for trading. This is when we're going to buy. This is when we're going to sell according to certain technical data and price.
And you hit enter and it tells you.
You hit enter, and I can back test it over the last 20, 25, 30 years.
To see if your ideas work out
exactly
through
right.
past markets.
That's exactly right. So the algorithm we're running right now, we only win 37% of the time. So we win 37% of the time. But our wins are 3 times more than our losses.
Right.
So because our wins are 3 times more than our losses,
It's 100%.
we make money.
Yeah.
Not for your other 70 or 63.
Well, if you think, no, he's saying he only wins 30% of the times, but then if you make that 3x fold,
Yeah.
it puts you at 90 basically, because the wins that you do make are
3 times more than what you've lost.
yeah.
We'll get out some papers.
Sorry, scribble. We can just scribble on the wall.
I went to college to be an English teacher.
You know,
but I couldn't pass the math, and I try to tell these guys I don't want to teach math. I want to teach English. But when it comes to numbers, I love data, but
what's crazy about Jared is he is such a gambler.
Yeah.
He is such a gambler that I'm surprised he hasn't because I'm addicted to. I'm a gambler. I just like to gamble in things I feel like I can win. Like I'm not going to go to Cherokee and play 21 because I know the house has the favor. I'm playing the odds on everything.
Yeah.
And in the market, that's why I like to play there versus anywhere else. You love to gamble. You love to go and play roulette. And I've seen you before at people's houses and be like,
who's got a deck of cards? I flip my card.
yeah, well, flip for 100, you know? Yeah. I mean, that's a 50-50 bet.
It is. Well,
it is, because one, you're either going to lose or you're going to win.
It is if it's 2 people.
Well, I thought, yeah.
Yeah.
But
if it's the 3 of us or 4 of us, but the risk is a lot more because the pot is a lot bigger.
Yeah.
Right.
So the reward is a lot bigger.
But the odds of you winning that are way lower.
But I can lose depending on how many people are. See, now I can talk math when you throw cards. And
We start talking about gambling.
If I've got 5
He's
people
in now.
He's in.
If I've got 5 people at the table and it's $100 a hand, I can lose 4 times.
Yeah.
And then I wash if I hit the 5th.
That's exactly what we're talking about. That's exactly what we're talking about with the whole risk reward kind of ratio.
You're risking 100 to make 500. That's the asymmetric risk there.
I can tell Blake's passionate about this because, man, he starts talking. He's over here.
Sorry. I'm going to have to do this.
Man, this is another thing you got to
I'm going to have to do this. Sorry.
Yeah, so you just put one hand here, you just go with it. So you're used to having a lapel mic where it follows.
That's right. It follows me
wherever
around.
you go. So that's interesting. I've got we use a company north of here, and Derek manages all of our accounts for that stuff. But he takes a percentage off the top. I'm sure your structure's the same way.
Yep.
And he sends me a report every quarter.
Yeah.
If I have a question, I can get him on the phone immediately. But it's like when Kyle told me to get into crypto, he's like, buy into it and never look at it again. Just leave it over there.
Yeah.
Because if you look at it every day, you're going to be banging your head against the wall. And that's what your job is for your customers.
Yeah.
You're banging your head against the wall. It should be no concern to your end users.
Crypto's really, really volatile too. So that's why I said that, because I didn't want you to panic when it was down. Or, you know.
Are you into crypto at all?
I never have.
Great. We're going to change. We're going to keep going.
So that's the same thing as him.
Yeah.
I would love to sit and talk to you about crypto because, and I won't make this a long deal because we've talked about it on the podcast a bunch, but there's actually utility in there.
Yeah.
It's actually businesses that don't have to be necessarily run by people.
The blockchain part of it and all that. Yeah.
And so if you think about it as like a business that you invest in the stock market, it's kind of the exact same thing, but instead of buying stocks in it, you're actually buying their native currency, or, you can call it whatever.
Yeah.
Now there's some that are junk.
Yeah.
Absolute junk. And I tell him all the time, I hate the word currency. I hate the word mining because it doesn't actually represent what is actually happening.
Yeah.
Most of these aren't currencies, they're technologies.
Yeah.
And the mining part is the work that's being done behind the scenes. And the people get rewarded for the work, right? Somebody has to do the work.
Yeah.
So before we got on, you said you can't just go out of your home office and have everybody come to you and see stuff. You got to be certified or have certain qualifications to manage somebody else's wealth account, right?
Yep.
So you mentioned that you had your Series 65. Can you kind of give an in-depth of what that actually entails and how hard was that for you? And
It really wasn't super hard, honestly. It is. It's an exam you have to take. So I studied for several months, and it was tough. It wasn't easy. It's one of those exams where you go in and you take it and you're like, I'm not sure when I press this button.
But if I'm right.
If it's going to say I passed or not. But
if I'm not mistaken, it's mostly around the legalities.
It is.
Right? Not actually how to do the trading.
Yeah, part of it is how not to get in trouble, right? How to not get in trouble with it. And so, how well you do in trading stuff is really not, there's not an appropriation for, hey, I passed this test, so I'm really good at this. It's I passed this test, so now I can legally do this. Right. And so, so make sure you vet your guys out there before you start giving them your money.
Yeah, the way you tell if they're good or not is you look at past history.
That's exactly right. Yeah.
Do you have a favorite stock movie?
Movie?
Yeah.
Oh man. Well, we were talking about The Wolf of Wall Street before we started.
Is that really a stock movie, or is that?
There's a documentary on Netflix about the GameStop thing.
Okay.
Oh yeah.
You remember
I
that?
love that. See,
have you seen that?
Yeah.
I hadn't seen that.
It's wild.
I'll have to
people
check that
got
out.
So basically what happened, I'll kind of give it to you in a nutshell.
Yeah.
In the market, you can buy a stock, or you can actually sell a stock before you own it. It's called shorting. Mm-hmm. So you can basically say, hey, like if you own, GameStop, mm-hmm. I could say, hey, I want to buy the right to sell that stock at a lower price. Does that work? No, I want to buy the right to buy that stock at a lower price.
Well, actually, what's happening when you short sell stock is you are borrowing the stock from your broker,
and then you sell it at a lower price.
That's right. So I'm borrowing it from them, and I'm selling it.
That's right.
Okay.
Why would that?
Hold on, because this is the thing. If you own a $10 GameStop stock, mm-hmm. and I borrow that from the broker, and it goes to $5, then I buy it because I only borrowed it before.
Yeah.
Then I buy it at a lower price, right? I'm trying to think. Hold on.
Why don't you let the wealth management guy take?
No, keep going. I like where you're going with this. Keep going. I want to see where
I'm trying to think. Hold on. I'll wrap my head around it. So, because it's more about the rights to you basically sell the stock that you don't have at $10.
Yes.
And you have the rights to buy it at a lower price.
Buy it back. Okay. So I'm borrowing the stock from somebody.
The borrowing part threw me off.
I'm borrowing the stock and I'm selling it. Like I'm selling it for. So let's say I buy it. I borrow it and I sell it for $10. All right, and it goes down. Right now, I've got the $10 because I've sold it at $10, but it goes down to $5. Now I can buy it back
and give it back to the guy you borrowed it from.
Because I'm going to have to give it back to the person I borrowed it from. So now I can buy it back for $5, and I've made $5.
Yeah, the problem with that though is if it goes up, you still have to buy that stock and return it to the person you borrowed it from.
But now you're selling it for more than now you're buying it back
for more than you sold it for.
Oh, I saw this on an episode of Billions.
Yeah. So the bad thing
Billions is a great show. I love that show.
Man. Have you ever watched it?
I watched a little bit of it.
Dude, no, watch all of it.
One of my top 3.
Are they coming out with another
series.
season of that?
Don't know.
Oh.
So the bad thing about shorting is this. So like if you buy a stock for $30 and it goes to zero, your risk is $30. Mm-hmm. You lose everything, it's only $30. Mm-hmm. If you short a stock, it can go up infinitely. So your loss is not capped. At some point, you're gonna have to buy that and sell it back to give it back to the person you borrowed from. So this is what the GameStop thing did. So you can go you can go in your portfolio, look at stocks, and you can see what the short interest is. So GameStop had like 85 or 75% short interest, meaning that most of the stock was shorted, which means all those people are gonna have to buy the stock at some point to then give them back because they're only borrowed on the short.
Okay.
So you have basically buyers in waiting. Does that make sense? Yeah. You have 85% of the stock.
Everybody just quit listening to the podcast.
Yeah. You have,
hold on. Yeah. Our legal team in the corner is making sure that we put this disclaimer in.
We're not financial advisors.
Do not take the advice of Jared and Kyle for this particular subject. Okay. Does that cover us? Yeah.
So anytime you have short interest, they're potential buyers at some point. More so when the stock goes down, those folks are going to buy and they're going to reap the rewards of that short play. The problem is what happens is when the stock goes up, they have what they call a short squeeze. Mm-hmm. All those people got to get out because they want to minimize their losses, and so it's already going up. And now you have people getting out.
It accelerates,
and they have to buy it, which makes it go up even more, which makes more people freak out that are holding it short.
Yeah.
So it's a short squeeze.
This happened on the episode where they flew to wherever Metallica was playing,
Yep.
and the friend was he overheard a conversation, shorted a bunch of stock. Well, it went the other way.
Yep.
Yeah.
Yep.
And it cost him hundreds of thousands.
Yep.
So
that's what happened with GameStop. What happened with
GameStop went from like $40 to like 450.
Yeah.
It was insane.
So what happened with GameStop was instead of it being a traditional market play, these guys got on Reddit and they're all talking. They're like, man, look at this short interest in GameStop. It's ridiculously short. And, you know, if you watch the Netflix thing, the guy that was kind of behind doing that, he said that he really, truly believed in the stock, which...
yeah, no, he didn't.
We don't know about that, but because technically you can't just get a bunch of people on board to, you know, go. It's basically a market manipulation if you do that.
Sure.
You have to actually believe in what you're buying.
I'll have to check that out. I'm sure you can get on Netflix and just Google GameStop, right?
Yeah.
So
they went in there and they basically did a short squeeze on these people. And once people started liquidating the shorts, it kept going up. More liquidations, it'd go up, and it went through the roof. Put one big
put them out.
Put them out.
But here's the bad part. You got people who are thinking, oh, this thing's going to go to 1,000. And so they buy it $450.
At $450.
And now they're stuck.
At $40.
Yeah. Now it's back to $40.
And
And people get really screwed by that stuff.
And the company's not worth,
No.
it's not worth
Absolutely
the $450 they paid for it.
I bet it happens every day.
Oh, yeah, that's the market.
You don't get stuff like that. That's like a once in a 10-year kind of thing with the short squeeze like that. But stuff like that does happen on a smaller level every day.
The problem is this, you know, I kind of hate the idea that people could do a short squeeze like that, but I also I hate the idea that these big corporations could put so much downward pressure on a stock. Yeah. And that's what happened. 85% shorts. I mean, these big corporations were basically putting tons of downward pressure on these stocks.
Whole thing's run by them big investors, the big investment firms, and all that.
Yeah. Oh yeah, they got the
whole
capital.
thing's run. Hacks capital. That's right.
They got the power.
They're market movers. They're market manipulators, and that's what they do.
What about commodities or day trading? Did you do any of that? Give me the background of what you were doing before you decided to get your Series 65, because you had to be in it a little dabbling for your own personal use. Right?
Yeah. So, years ago, I in between teaching and going into ministry, I applied at Edward Jones. I actually had started that process when I ended up going into ministry. And so I've always been really interested in the market and what's going on. And so I got involved in day trading futures, which is a whole nother kind of, mind-blowing kind of thing. But I love it. Day trading futures taught me more about the market than anything I could ever do. Do it. Don't do it with real money, okay?
Yeah.
Do it with paper money, fake money for a long time before you ever put any real money into it, because there's a cost to education, right?
Yeah.
So,
flashback
to Brad Price. There's a cost of education with that. And so, but you learn so much from day trading futures that just about the market and how it works and the mindset of people who are investing and sentiment of the market, which is a huge thing.
Yeah.
And so I did that a lot. Always paid attention to certain stocks. I did the whole retirement thing and put money in retirement. That's kind of where I was before I started doing the trading, and I'm able to understand how to manage people's money and how the market works now better because I did some of those things. If I were just to come in,
never done it before.
Green, never having understood the market at all.
Yeah, my mind was blown when I figured out you could actually trade orange juice.
Yeah. Commodities. Yep.
Yeah.
Who knew?
You want your mind to be blown. Let's sit here and try to explain futures to people.
Or options.
Or options.
Options are tough.
Options, I just completely stay out of that. I can't, my certification doesn't allow me to trade futures for people.
Yeah.
Or options for people. So I can only do stocks and bonds and stuff like that. So, but I can't do futures. I wish I could. I love futures.
Yeah, options is kind of like, I guess that's kind of what I was trying to describe earlier where I was off on the shorting. You're basically buying the option to buy or sell that stock later on. Yeah.
Yes.
And it's cost you cents versus the whole price of the stock.
Yeah.
But you lose all of it if you're not in the money. I know. We'll move on. All right.
I tell you what, let's not move on. Let's buy some stocks of our own and take a word from our sponsor, Shane Smith from Allstate. And when we come back, we'll still have Blake Pitts with us, and we're going to find out why Blue Horseshoe loves Anacott Steel. We'll be right back.
Let's face it, shopping for insurance can be time-consuming. When it comes to your auto and home insurance needs, make things simple and trust your Allstate experts. They will help you get the coverage that fits your needs while helping you bundle your auto and home. Bundling saves money, sure, but it also saves you time. So you can enjoy the things that matter most even more. Contact Clemson Allstate agent Shane Smith at 864-654-1047 today for a free personalized insurance proposal. Allstate, are you in good hands?
All right, we got Blake Pitts. We're back. Blake
Yes.
Pitts, SouthCack Syndicate Podcast, talking stock market and Wall Street and a little
Investing.
bit of all that is in math, equations, and risk management.
So what was the quote you gave us before you went to break?
Blue Horseshoe loves Anacott steel. Now, I'll say this before we get into that. The first person to email us at
SouthCackPod@gmail.com.
will get a SouthCack hat.
Oh,
So, yeah,
He would definitely be
phone?
the first one.
where's my phone?
he would definitely be.
I'm going to do it before we leave.
The good thing is you get a hat.
So we want to know what movie and what year the movie came out that belongs to the quote, Blue Horseshoe loves Anacott steel. Guys, this is so easy. First one to email gets a SouthCack hat.
I know it.
Boom.
Okay.
Yeah,
Well,
yeah,
yeah,
Yeah, because we talked about it in the break.
As soon as Blake gets in the car, he's going to email us
you can't email before the podcast.
before it even airs.
Yeah, so not applicable in Hawaii, overseas, or from Blake Pitts.
That's hilarious.
Okay, so during the break we talked about high frequency trading.
No, we were just talking about futures and options a little bit, I guess.
No, during the break.
Oh, during the break, yes.
Yes.
Yeah.
So Blake, can you tell us a little bit about what high frequency trading is and how that, do you do any of that currently?
He can't, I don't think,
No, we can't do that.
Yeah.
Yeah.
Okay.
We're pretty much your traditional IRA investment. You know, we do it in a different way. So we're active traders rather than passive traders.
Okay.
Like, I mean, if you're at a place where you're down 35% and they go, oh, it'll come back. Like,
yeah.
why aren't you paying them?
Yeah.
Like,
Yeah, because they're not doing anything.
they're not doing anything.
They're just telling you to wait.
Yeah, they're your access to the market, which with the way online is now, everybody's got access to the market. Like, you don't really need
doubt.
Yep.
You don't read it. You don't need it anymore. So, put your money in an ETF or, diversify it a little bit if you want to.
Yeah. If you're not going to move it, then you might as well
call
do it
me. I'll
yourself.
tell you what to put it in. If you're just going to put it and leave it, then you don't need an investment
Some with
advisor.
a dividend.
Yeah.
It's going to pay you to wait.
Yeah.
Then let me ask you this. Convince me, because I'm not in this space,
Okay.
to any account, right? Convince me why I should stop buying real estate and start investing in stocks.
Well, hold on.
No.
Because I don't think anybody suggests you.
I'm not. I'm just,
Oh, okay.
I want to hear it from the stock, from
Yeah.
the
As
wealth
a-
management guy.
Yeah. I'm not sure I would.
Okay.
That I would tell you to do both. Is what I'd tell you to do.
Do you think that stocks are more secure, the most secure
All right,
investment?
so they're more liquid. So real estate, it's gonna, for the most part, all right, it's gonna take you time you're gonna have money, you may be leveraged, you may have money tied up, and then you gotta find a buyer. If you buy something that you're gonna sell or flip or whatever, you're gonna have to buy it. You're gonna have to go through all the legal stuff to get it. So it's gonna take you time to buy it. Then you got to find a seller. It's gonna take you time to sell it, and then
You got to wait on closing.
then you got to wait on closing. So all that takes time, right? Which there's a risk to time, right? And so within the stock market, you can have
Right now.
$500,000 worth of stock, and I mean, like that,
Gone.
It's gone. I mean, you can liquidate it
Money
right
in your account.
now.
Yeah.
So
It's like cattle.
Yeah, I guess so.
You can get a check in your pocket every Tuesday the sale doors open.
Yeah, the thing about cattle though is you're still kind of waiting. I guess stocks be the same way. You're kind of
It's
waiting.
a market.
Yeah, it's a market. But on the cattle side, I guess if you're trading cattle, but if you actually own them, you're kind of waiting for them things to fill out and whatever. Yeah.
Well,
My
and we
cattle
talked about-
reproduces more cattle.
Yeah. Yeah.
So it's I look at cattle. Megan looks at cattle as ears, hooves on the ground. I look at it as compounding interest.
Yeah.
Absolutely.
So that's
That's
why I look
exactly
at
what it
like a
is.
dividend stock. Like everything I got has automatic. What is it they call it? Where it automatically buys more shares.
yeah. You just reinvest. What
You
you
just
got.
reinvest.
Yeah.
So like my cattle would be like,
Ford Motor Company.
yeah. And then when they pay me the dividend, it automatically buys more Ford Motor Company, and it just had babies, and and it just grows.
Fair.
Yeah. So I don't know if I would tell you not to do that. I think I tell you to do both, because if we talk about risk management, if all of your money's tied up into real estate, then you're going You're gonna have liquidity risk. You're gonna have time risk. Like there's risks to real estate that you would not have in the market. So diversity is good there.
I will tell you too, you can invest in real estate through the market. So it's liquid and you're in real estate.
I like the touch and feel of
I get
whatever.
that. I get it.
I get
100%.
that.
Cattle, dirt, brick and mortar.
Yep.
I can
I get it.
knock it over if I need to. You know.
Yeah. 100%.
That's I never understood investing in wealth management companies that do real estate. You know, and it's
what it is?
who is it?
It's a trust, so you can invest in REITs.
Cardone Capital. That's
Yeah.
exactly what he sold, right? He was like, all right, you give me your money and I'll promise at least 2% on your dollar, which is still more than the bank is paying you for your money, right?
Yeah, that's not what he says, and that's not how his works. You're actually you own basically part of the property.
Yeah.
And they have to cash you out on that property when it sells, type of deal. So like you own a percentage of those properties.
He's running a real estate group, like an investment group. That's what he's doing.
But you can invest in REITs, which is a real estate trust. And the largest, some of the largest real estate trusts that own most of the real estate, and you can get it in different sectors. It could be in commercial, it could be in residential, it could be in
But it's not
farmland.
fun. Like it's not fun like you want it to be.
It's exactly right. Yeah.
It works like you're investing in the stock market. Yeah. You look at a chart and you buy it at a price and sell it at another price.
See, I enjoy doing the research. So I have actually two different trading portfolios.
Yep.
I have my one that's almost all dividend stocks. It's kind of like my 401k, I guess. And then I've got the one where I'm like, let's roll the dice. And I'm like in ARC. I like the technology stuff.
Marijuana companies.
No.
You're not in marijuana stuff?
It had its run, but I'm more of like, if I see future in it, and I think, not that I don't really care about marijuana one way or the other, to be honest with you, I'm sure it's going to be everywhere at some point. Yeah. It's happening, you can watch it, but the money, there's no technology in it, and it's not going to be a lot of money. Once it's everywhere, and it's like,
like once it hits its peak, it's there. Like it's not a lot of growth to it.
So I'm looking for like the next things, and that's on that one side. That's all I trade. I'm looking at the companies are starting like trucks that are all electric, and they're going to haul stuff around the world, and the genome stuff, and the cryptocurrencies, and I'm like, I get into a lot of that stuff. So that's where I play, gamble.
I play with Apple.
With Apple?
Yeah, probably 10 years ago, Kyle's in my kitchen. He was like, dude, you need to buy a couple shares of Apple stock. It's like at $7 a share, and I think it's going to go up. And I was like, okay. Well, I spent 30 shares or so, whatever. I don't know what it was, what I paid for it, $21 maybe.
Yeah.
And so I think I'm up 700%.
Yeah.
But
he didn't put enough in.
At least.
It's been a long time, right? So if I was to really get into the micro of what I make annually, it's like like 40 cents.
It is, you're right.
A year.
But the thing is, the thing we're saying though is
it doesn't excite me.
It's very passive though. Like you had to do absolutely nothing with that.
That's right.
Whereas stuff you're making more money locally, but you have to be in there. You're dealing with tenants. You're dealing with buying, selling.
But I could have took that same $1,000 to Harrah's.
Bet on
There he is with the betting.
35 to 1 odds.
That's
But
why
it's kind of like so apparently the real estate, the whole if you're investing in rentals, you want to be at 1%. Like that's the
1% rule.
the 1% rule and whatever. And it's kind of like the model we run, we make somewhere between 11 and 13% year over year. So it's kind of, if we're making that per year, you're trying to make at least 1% a month. You're almost ending out at the same place, right?
So that's a good point, because you're saying if you're trying to get 13% a year, that means you're going to make 130% on your money in 10 years. The 1% rule is basically around a 10x capitalization rate, right?
Which goes out the window when interest rates are where they're at, because if I took my rent roll for this building and said I want this much for it based on the rent roll, I think when COVID hit.
No, it's just for buying.
That's right.
Yeah.
But there's no way I would sell at the 1% rule, because we're so high up in our market right now.
The advantage, and
these contracts signed 4 years ago, so they were valid in the 4 year ago market.
Yeah.
They're not valid in 2023 for me. So,
I think long term real estate is definitely the better investment, which is why I've got in the game, because rents are going to continually go up.
You want to sell that building?
Yeah, sell for the right price.
1%.
1% of what?
If I use the 1% rule to buy it,
Oh, if you back out my no.
See what you proved my point right there.
You're right.
Blake, who isn't the stock market for?
Who isn't stop? Ooh. People that ain't got no money.
Is there like I hadn't invested and I'm 70?
Yeah.
Go live your life. Go buy an RV.
Yeah.
Don't risk it.
I would not risk it if you're 70 years old.
Yeah.
I mean, in the traditional income, I think we're a good bet at 70 years old because we manage risk in a way that actually makes sense.
Now you could preserve if they're already wealthy, then yes, you need to invest it where you can preserve wealth and kind of match inflation and whatever you know.
Yeah.
But if you don't have anything,
well, right now, I mean, you look at where the interest rates have gone up so much, you can get an high yield savings account and get 3.5-4% on a high yield savings account. Of course, you're still half of what inflation is.
Yeah.
But at least you're not losing money. If you're 70, I would never suggest anybody other than that do that.
Anybody that's listening, I will tell you this: time is the most thing in your favor when it comes to investing. So if you're young, start now.
Yeah.
Just buy something that pays you a dividend. Have that dividend reinvest itself. Buy a company that you know is going to be around in 30 years.
It's called real estate. Buy yourself a boat.
Well, no, hold it. The difference is though, if you're 17, 18 years old, you're not going to buy.
You don't
a
have the money to
buy a rental house.
But if you got $50, buy something that's going to be around for the next 30 years. That's going to pay you a dividend, and what you'll find is that compounding effect will really accelerate when you're in your 40s.
Or here's what you do: you buy real estate, you make your 1%, you do your thing. And you put that money in the market, and now you're making it on both sides.
Your overage, that's right. And play Monopoly when you're young, and play Rich Dad Poor Dad.
There you go.
And learn. Like my biggest downfall is I didn't start learning until my mid 30s.
Yeah. Oh, money's a game.
Mid 30s.
It's a game. It's gamified. It is 100% gamified.
Well, if I would have known what I know now.
When I was growing up, it was just you go to high school, you graduate high school, you go to college, you get a normal job, you get like all this whole thing about hey, how do you make money? How do you make money, and then how you make that money make money? You know? And I never even thought about that. I was like, you just work a job and get a paycheck, and that's it. And it's like,
and you're going to work every day until you die. If that's the rule you follow.
Yeah. And so now, I was just kind of open. We're not bound by that. So
no, it's a gamification of resources. That's all it is.
Passive income is so much better than earned income. Mm-hmm. Not only is it passive and it's easy, it takes a lot of work to get to passive income. So it's not like, he lives off passive income. Well, you don't know. You didn't see the 5-6 years of bloody knuckles to get to that point. Right? Stock market's probably the same way. It took a lot of work to put enough money into your wealth management portfolio to start seeing dividends. And you don't have to reinvest your dividends. You can actually get your passive income through your wealth management company, correct?
Yeah. I will tell you one advantage that I see to hard assets versus doing the stock market stuff is that you don't have to have as thick of skin. For instance, you buy a building, when the market's down, you still own the building, right? In the market, really all you're looking at is your overall number. And when that goes down 50%, for somebody that hasn't rode those waves before,
it's hard to stay in,
That's really tough. And the last thing you want to do is buy at the high, sell at the low.
Well, that's what we're seeing right now. After COVID,
well, no, it's bounced back a lot.
Everybody started coming here and buying houses.
You buy houses.
Yeah. Well, they saw the opportunity. Well, we'll buy a house. We'll Airbnb it.
Yeah.
That'll cover the mortgage, and we'll go back to wherever BFE we live, and it'll pay for itself. Well, if Airbnb drops, and they bought at the premium market, and the interest rates are still high, they're going to start selling real estate. Whenever that starts happening, market comes down. So it's just a check and balance of its own self, and it's like a breathing, living thing that you can't see.
I love how it self-regulates. I think that's the best thing about it.
And that's what the Fed's trying to do with the interest rate right now.
Yeah.
I mean, they keep raising the interest rates because they're trying to put the brakes on the market.
Yeah.
Inflation was going crazy. Anytime inflation goes crazy, you've got, too much money chasing too few goods. And so the only way to fix it is to go, okay.
Yeah. A couple $1 trillion will do that.
Yeah.
It's like,
no doubt.
Everybody's rich for a little while.
Well, it's like, stop printing money.
Yeah.
See, the sad thing is this. I believe that you should let the market figure all that out. And I think the Fed shouldn't necessarily kind of manipulate it. I get why they do though, because there'll be tough times if they don't.
Well, there may be tough times if they do.
Well, you're right.
Because
they're trying.
It's a tough balance because what ends up happening is they raise interest rates so much that the market has to. It does what they want it to do. It goes down, but you don't. It's a lagging indicator. So they may overdo it. Right?
Yeah,
they may overdo it with interest rates and say, well, the cost of goods are so high now because the interest rate's going up that they drive us into a recession. And so what's better, runaway inflation or a recession? It may be a depression.
But I guess the point I'm trying to make is like not even print the money to begin with.
Yeah.
Well, let the market figure it out.
It doesn't matter.
100%.
It doesn't matter if they printed or not printed anymore. After 1971, we came off the gold standard. It literally doesn't matter.
When you inject trillions of dollars in the market,
Backed by what? What's the value?
it doesn't matter if it's back. That's what I'm saying.
But your value of your USD is not 100 pennies.
Right. But so the value of $1 is based on the goods you can buy with it. Okay. And so when you pump a ton of money into the economy and people have more money they can buy more goods with,
It's how we get in trouble.
it's how we get in trouble because then there's a supply and demand issue. There's plenty of money, not enough, there's plenty of demand, not enough supply. That makes the rates go up on this side.
So what you're talking about is what we saw in 2004, 5, and 6. You had the bank tellers making $24,000 a year, driving an $80,000 Audi in the parking lot and owning a $200,000 house. When you see those kind of things, and I had a banker tell me this, and he painted the picture just like that. And he said, when you see that, buckle up.
Yeah.
Because that's when
So
we're about
I'll
to
give
be
you
in
a
trouble.
prime example. In 2008, when the market crashed, the housing market crashed, they came in there and bailed out all the banks and stuff. In my personal opinion, now obviously I don't know because we didn't see it happen, and I don't know what would actually have happened. But those businesses that don't run, a business that is not run properly should go out of business. In my personal opinion, they should have let all those fail.
Should have let them die.
They should let them die. You want to, and then it kind of send out a signal to everybody else. You want to play that risk game? We're not bailing you out. You're going under. Let them go under. What'll happen is these other ones that actually run their business properly, they'll come in there and swoop up all the assets. So it's not like people are going to, it's going to be this huge mass exodus. They're going to come in there and buy it for cents on the dollar. People are still going to keep their houses. All that stuff but instead what happened was the Fed just sent them a ton of money to make them right. And then they didn't change their ways.
No, it's still a bad business.
It's still a bad business.
Well, see, they ought to do that to everybody then. Well, let me go run out of business. If I fail, I'll just expect the government to come bail me out.
No, that's what I'm saying. So if me and you start a business or anybody else that's probably listening to this,
doesn't work that
if you
way.
don't run it properly,
You're going out of business.
you're going out of business.
It's the way they weed out bad
It
businesses.
should be like that.
And good business rises to the top.
That's what it
Be
should be.
rewarded for holding on to your own. I know a lot of extremely successful businessmen who filed bankruptcy in 2008. And some of it needed to be filed, but it doesn't mean that they went under, right?
This
LLC filed
with some
bankruptcy.
debt.
Not my entire company. And everybody's like, oh, well, so-and-so filed bankruptcy. Yeah, I did with that little LLC I started. Because I filed bankruptcy in an LLC in 2008.
Yeah,
five houses in downtown Chicago in 2008 hit, and it was like, there's no fixing that.
It's a dead asset,
So I let that company file out, and we kept on trucking.
Which is why they have it there.
No, that's right. That's exactly right. Blake, do you have an equation or examples of major stock market? So if we look in the past 100 years of stock market or however long it's been in conception, you remember Black Monday or Black Friday, whatever it was, and remember the Great Depression, those things like that. Was COVID one of those holy cow moments in the stock market?
Sure, for about a month. And then we had one of the biggest rallies we've ever had. I mean, it was insane. You look at, and this is why I keep coming back to risk management over and over again. But the reason it's important is because you have things like COVID that happens, but without the run back up. So you never know how low is low. You never know how high is high.
Right.
People say that. Well, buy low and sell high. Well,
You don't know where that is.
How do you know where low is?
If you
and how
do,
do you know where high is?
Yeah, if you do, it's easy.
Yeah, and there is.
We wouldn't be sitting here doing
exactly
a podcast.
right.
Yeah.
We'd be racing our Ferraris.
That's exactly right. And so you have these large periods of time in the history of the stock market where decades at a time where the stock market doesn't make another high.
Yeah.
Right? It doesn't make a new high.
Yep.
So in the 20s, right after the Great Depression, there was a time, I think from the 70s to 80s, about a 10-year period there. It seems like it was about every 30 years. And then from 2000 to 2009 or so,
It's just
there
stagnant.
wasn't. And so the reason you risk manage And the reason I'm not for the buy and hold market or buy and hold model where you go, I'm just going to keep it in there. If it goes back, guys, it's going to come back up. Well, yeah, it will. But what if you got to retire in 5 years?
Yeah.
You know, what if I'm going to retire?
That's right.
What am I going to retire in 5 years? And my
I don't want to wait out the correction.
yeah, I don't want to wait it out. And who wants to?
Right.
You know what I mean? Who wants to not make money in the stock market for the next 10 years?
Because you're pitching quick liquidity.
Yeah.
Well, in this scenario that you just gave, Jared, I understand that you want to cash out, but if I were you,
I'd
wait
wait
3 years.
Yeah.
I'd be like, I wish I'd have bought a building.
Yeah.
But buildings would probably be down. Depending on what's going on in the market.
Yeah.
But
Do you see the same uptick and downtick during presidential election cycles?
Oh yeah, for sure. Right.
Yeah. It's so volatile right around November every 4 years. Mm-hmm. So it gets super volatile. And then you see this I thought it would go down after Biden. I thought it would just tank. And it didn't.
Yeah.
Like it just kept going for a whole nother year. And then last November is when we saw an all-time high in the S&P.
Sure.
And things just started. And ever since last November, things have just steadily, kind of the steady decline in everything. And so, yeah.
I got another question, and I kind of want to spend just a little bit of time on this. This last question I'll have for you.
Okay.
Is there a reason, and it could be happening today, I'm not self-educated in this question. Is there a reason that an AI company couldn't let machines do all the trading and be more accurate than the human element?
It's already happening.
Oh, yeah. It's happening
That's
now.
what I'm saying.
Yeah.
So do you think that they'll regulate AI in trading at some point?
They have to, right? I mean, they're gonna have to.
So, in the grand scheme of things, we kind of talked about this. I don't know if I mentioned it on the podcast or if it was before the podcast, but the stock market in general has little to do with the underlying company in the short term. In the long term, it does. Like, if Google is going to continually to make more and more money, and there's an evaluation that they can do on that company based on the money it makes, and you can equate what it's worth from that, then you can, over the long term, if you pick a good company and it continues to be a good company, then that stock will go up.
And how many times, I know where you're going with this, because how many times have we seen really good fundamentals behind a stock and the stock just crashes?
Yeah. So in the short term, what you're trading basically is the mindset of everybody else that's trading, because it doesn't matter how good the company is. If everybody's selling it, the stock's going down, right? And so if everybody's freaked out about something, it's all about the mindset of whoever's buying and selling, right? And you got to figure out where that wave of people is.
Right. So you're saying AI is already doing that better?
Yeah, absolutely. Because it's not a fundamental thing. It's not a mathematical, oh yeah, they made this much. If you could just do a mathematical equation on the company, you actually can, but it's going to show you how good the company is. It's not going to necessarily tell you what the stock price is going to be. The stock price is based on what people are buying and selling, and that's in between their ears.
It's systematic. So he's saying they've created a system out of it that's not emotional. We're all emotional, right? And this gets even more exaggerated. This gets even more exaggerated in day trading. Like the shorter term you go, the more sentiment matters, right? Because we're all emotional. You got a bunch of day traders. Everybody's sitting there looking at the same the chart. They're sitting there looking at the same thing, the same price, the same whatever, maybe at different time frames, but everybody's looking at the same thing. And so if something starts tanking, then you're like, oh man, I'm getting out. I gotta get out. Or if you're looking at something that's just kind of ranging in one area,
all of a sudden it breaks out.
All of a sudden it breaks out. Everybody's like, I gotta get on that. I gotta get on that. I gotta get in. And then those are suckers, because a lot of times those bigger guys are then going to start shorting it, and it's going to start going down. Everybody's going to start getting out, and then it accelerates to the downside. So you've got this this emotion of people, and computers don't have that.
Well, and the thing that's crazy is everything he just said had nothing to do with the company that they were trading.
No.
And that's the point I'm trying to make, is in the short term, it has nothing to do with the company. It's more about the sentiment.
Yeah. That's why you systemize things. That's why we've done algorithm stuff. It doesn't trade for us. We do it every day, but it tells us, and we put in buy signals and sell signals on the daily, depending on our algorithm, because it's systemized. There's no emotion in it. You don't get wrapped up in, I really love this company.
You just test
it.
You just continually back test your system and make sure it still looks.
That's right. And we can tweak things to go, oh, okay, this is better than that.
Yeah.
And if it's better now, past performance does not indicate future result. Okay, so you don't, you got to throw that disclaimer out there, because it doesn't. Back testing isn't perfect.
Wait a minute. Legal
okay,
teams.
all right, legal team's good with that.
What is the saying? The past is not a prediction of the future, but it rhymes or something like that. Isn't there like a? I don't know. It's not exactly the past is not going to exactly be what the future is, but it's going to be close.
Yeah. We can get a good idea of what it's going to be. It's not as exact science, or like I said, we'd be driving really nice cars right now.
So the whole thing interests me. I mean, because there's two sides to it. I mean, you can look at technical traders, and just the fact that they see these patterns tells you that humans created that pattern of trading.
Yeah, it's a self-fulfilling prophecy.
Exactly.
History doesn't repeat itself, but it often rhymes.
Yeah.
As Mark Twain is often reputed to have said.
See, my memory's not good enough to know
often
exact
rhymes.
quotes.
There you go.
Often rhymes.
Yeah.
So where can people find you? If you got a website for IQ Wealth Management?
Yep. They can go to IQCapitalStrategy.com.
Instagram, Facebook?
No, I'm not much into social media. I should be, but that's just my nature. I don't do that much.
And
It's probably not a bad thing.
Yeah.
For IQ Wealth Management, are you managing 5 million, 100 million, 20 million? Are you somewhere in that?
Yeah.
Range?
So I just started. I started about 3.5 years ago. So, but I'm working with a guy who's been in it for 20 something years, and but we're managing somewhere between $15-20 million right now.
Okay.
And
so it's not. It's not a small group.
No, it's not a small group. It's not. It's not your $100 million kind of deal.
Yeah.
But
we're in a small town.
But
too,
we're getting there. We're in a small town, and it's very relationship driven. And
Your office look like Axe Capital?
no, it doesn't look like Axe Capital.
Are you hiring?
I wish.
They have the best parties.
But when people need to talk to somebody, they got my number. They can call me, and I answer my clients when they call. And
that's a good thing. Is it like it's more of a personal?
It's important.
Yeah.
Because they are. I mean, literally, my life savings. You have my life savings. I've worked 35 years to have you manage that for me.
Yep.
That is such a relationship.
Yep.
It's not just I researched the best company.
Yeah.
It's I researched Mr. Pitts.
Yeah.
Mr. Smith and Mr. Jones, and I like Blake the best.
Yeah. They got to trust
really
you.
entrusting.
Yeah.
Do you have a favorite quote for people that either success quote, business quote, stock quote, get it?
Yeah.
Bible verse,
Stock quote. Apple is that? No. Probably one of my favorite quotes is leaders are at their best. Leaders are at their. I see if I can remember it. Leaders are at their best when you barely know they exist, and when they're finished with their work, and it's all been fulfilled, the people will say, "We did it together."
That's pretty deep.
So he led them, and they didn't know it.
That's right.
Yeah, that's awesome.
Or a wise man plants a tree that he knows he'll never stand and see the shade of.
Yeah.
Yep. Good deal. Appreciate it.
Blake Pitts.
Yes, sir.
Thank you for your time.
Good to be here. Thanks for having me.
Wealth of knowledge, no pun intended. So we'll have you back, guys.
Please
you
do.
can find Blake Pitts at IQ Wealth Management.
Yeah, you can email me at blake@iqcapitalstrategy.com. Blake at iqcapitalstrategy.com. It's kind of a mouthful.
And give them the website one more time.
iqcapitalstrategy.com.
Okay. Guys, thanks for listening. We'll see you next week.